Let's welcome in Rohit Agarwal now. He's joining us live. Rohit, how have things been in 2020? If I describe the year, we hit a low of 7,700. We hit an all-time high of close to 13,800. What does this mean?
Hi, good afternoon. What this means is that there is volatility and there is sharp volatility, and the markets currently have already found their vaccine, and that vaccine is liquidity. So as you said, that the markets hit their rock bottom in March this year. Now, that's the biggest difference that the markets have seen in this pandemic versus what happened in global financial crisis, where the central bankers took anywhere about 3 to 8 months to react and pump in the liquidity. Whereas this time around, come March, the market was already flush with liquidity. And as we speak right now, we are expecting that in calendar 2021, the liquidity will be anywhere between $300 billion per month. So unless something goes horribly wrong, either on the inflation side or growth surprises us very meaningfully on the upside, this liquidity, or the current vaccine, as I would like to call it, is here to stay.
Right. Rohit, just request you to stay on with us. My colleague Ruchi is now joining us. We earlier got her on a bad line. Ruchi, take it away. Tell us about BEML and what are you picking up in terms of divestment for that?
Just last week, the disinvestment secretary spoke to ET now, and he said that the government is going to continue with its strategic stake sale process, and BEML, along with Neelanchal Ispat as well as Concor, will be the next few companies where the government is going to put out the expression of interest, calling for bidders to pick up stake in these companies. Now, we're given to understand just yesterday, the cabinet secretary-led CGD gave a go-ahead to BEML's expression of interest. The ministerial panel will very soon meet over the next few weeks to clear the BEML EOI, and thereafter DIPAM is going to put it on its website. Important to note that the cabinet secretary-led core group of secretaries has said that the land parcels of BEML are set to be sold separately. In this process as well, PSUs will not be allowed to bid. However, private companies can, participate in the process via a consortium. We're given to understand the government plans to sell about 26% stake in BEML. They currently own about 54.03% stake in BEML, are likely to give up management control as well. So this, of course, is going to be another important company that the government is looking to hive off, of course, coming in after the government has received multiple bidders for BPCL stake sale, and besides that, they have put out the expression of interest for Shipping Corporation of India as well.
All right, Ruchi, thanks so much for that. Let's go back to Rohit. He's with us. Rohit, what do you make of this whole whole PSU divestment? Do you think that's a key trigger? And you have one or two big strategic stake sale. The sector has a lot of value.
Well, the sector theoretically always had value in it, but the proof of the pudding lies in having it, in the sense that you will have to wait and see how one or two big strategic sales or divestments go through, because they have been in the pipeline for quite a few years, but they somehow or the other haven't gone through. The market gets excited as and when new names are announced, but invariably the excitement dies down or tapers off once we see that the deals have not gone through. So for any real excitement to come back and real money to be made, we'll have to see one or two real deals happening, and happening at prices which the market believes gives them substantial value over the current prices, for them to be able to then say that, hang on, now we believe that the PSUs as a pack can create some good shareholder returns in the years to come. Otherwise, it can still continue to play in the way it is, where intermittently you hear about this divestment or the other, but eventually nothing much happens.
What will be your top sectorial bets? Would you look at high PE, high growth stocks? Is that something which you would continue to bet, which has done well for last 7-8 years?
Well, in a top-down world, which is driven by liquidity, we prefer a bottom-up approach. to evaluating which companies have good earnings potential. The way we look at it is the sectors that we currently like are some sectors which we already used to like pre-COVID. Those sectors would be, say, specialty chemicals. Some of the sectors which we have started to like now are the ones which are related to the PLI schemes. The mobile PLI scheme has been a huge success. Now we believe the other sectors where the government has outlaid about $100 billion or $20 billion for the next 5 years, some of the sectors in auto anchs, pharma, and logistics and textiles may be the sectors to look at, which will create good traction in their earnings. Apart from these, we also currently like the real estate sector as a whole. When we say real estate, it does not necessarily mean all the real estate developers. Some developers who have very good balance sheets and are in the right areas. But what we also believe is, given where interest rates are currently, which are at historic lows in terms of borrowing for real estate, that typically is a sign for the bottoming of real estate. And even in cycles, if you analyze, there are very rare occasions when you see that the equity markets are at highs and the real estate market are not at highs. This is one such cycle where I've seen that the equity markets are at highs, but the real estate market are anywhere between 20 to 40% down from their peaks, give or take, depending upon the cities that you talk about. So given the interest rate scenario, given that the real estate prices are low, we believe there is a bottoming out process which is happening, and currently inventory is getting liquidated. And if economy were to come back to growth, which we expect that in FY22, the economy should grow somewhere between 8 to 12%, I think real estate as a sector, plus the ancillary activities with real estate that go with it, that could be cement, that could be paints, that could be tiles, that could be plywood. Those are the sectors that we like and we are currently bullish on.
Right. In terms of financials, how would you approach the market? I mean, there are two ways to look at it. It's the first time, once again, even the largest weight financial company asset quality is being tested. They have to raise funds. So how would you look at that space?
Well, for financials, one good thing that happened in this scenario versus, again, the past cycles was that most of the financial companies in India were able to raise capital. And now in financials, given that they are leveraged institutions by definition, leverage is what kills them. And when they have capital, it gives them better cushion to take care of any asset quality misadventures that may happen. So financials have done well, not just because the economy has rebounded or that we are looking for the vaccine, getting the whole vaccine thing being there, but it's also to do with the capital buffer that most of the financials today have. So financials, even though they have rallied, they may continue to do well. But financials as a space has always been a bottom-up area where we believe some of the larger ones who have greater and better balance sheets and have held on to asset quality challenges better in the past and also in the current pandemic and are well provided for are the ones that will likely to continue to do well and not financials as a whole. So we believe companies in financial space who have dearth of capital or who have asset quality challenges even now are not the ones to back, but the ones who have a lot of capital and are lean on the balance sheet and on asset quality are the ones to back.
Right. Also, when we just look at the financial pack, the stronger the better. It's not like a mid-cap space where you believe that the percentage growth or the leverage could be higher. The stronger the balance sheet, the more comfort it is.
Well, yes, even though in cycles of great economic growth, you will see in the financial space mid-cap companies doing slightly better than the large cap simply because, as you said, they can grow faster. But invariably, barring a few mid-caps in the financial space, most of those financials tend to underperform in a scenario where the economic activity is not great, simply because having grown at a very rapid pace in the past, they then have to bear the burden of asset quality issues. And hence, they have to again go through a cooling off period or getting their house in order and then only come back in the whole scenario of growing well. So in the financial space, we do not necessarily look at companies which are the fastest growing, but we look at companies which are more consistent and are able to pick and choose the sectors that they do not want to lend to. Bear in mind, in financials, the easiest thing to do is to lend. But the most difficult thing is to collect the money that you have lent. So the banks or the NBFCs who are able to stay away from the asset quality sectors which eventually crop up 2 or 3 years down the line, which means those banks or financial institutions which are able to preempt problems in particular sectors and are able to stay away are the ones to back, and not necessarily the ones who grow their balance sheets faster.
Right. Right, sir. Thank you so much for taking out time for us. Always good to get perspective from you. That was a view coming in from Rohit Agarwal talking about the markets, the way ahead, and how essentially you can make your portfolio for 2021. On that note, we are taking a break. Coming back quickly. Stay tuned.